I have 500 rupees and I want oranges and apples. Sir, for rupees 500, you can have an assorted fruit basket of a bit of every fruit.
That's exactly what an exchange-traded fund does. It gives you access to the whole basket when you choose an ETF. Aim to enjoy the fruits of your investment. Invest in ETF. Smart option choose karo. ETF karo. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hi, everybody, and welcome to this very special series of webinars brought to you by Mirae Asset. And, we've been focusing a lot on ETFs. How do you go about it? How do you understand the world of ETFs and whether ETFs really are the future in a market like India? So today, we want to focus on how investors can actually get exposure to the global markets through ETF. If whoever has lived through 2020 has known that one of the buzzwords of the year has been international exposure, and even in 2021, this is a theme which is playing out very, very well. So, how do you actually go about it? How can you invest in innovative new themes, which currently may not be available in India? Are they a good portfolio addition? How do you synthesize it with your existing portfolio? And, how do you do all of it, whether you do it the active way or you do it the passive way, which is a better strategy? So let me invite two experts today, Siddharth Srivastav, the head of ETF products at Mirae Asset, and Vishal Dhawan of Plan Ahead Wealth Advisors. Gentlemen, thank you very much for joining in this webinar series. And, Vishal, I want to first begin by asking you a question because, you have been directly dealing with investors. What are the kind of questions that you're getting from investors about global exposure, international investing? Are they keen to do it? And what is the advice that you've been giving them?
So I think the realization and the acceptance is happening in a very slow manner. I think it's been a gradual process, and I think that's quite natural, especially when you go through certain years like we've gone through where things have been much stronger, where India's done much better. And therefore, I do think that this is going to take its own time to happen for greater acceptance to take place. But I do think also simultaneously that for people who are aware now, I think they are much more open to looking at things which are either broad-based or narrower on the international side. And I think the key for them to be able to achieve success in this is going to be how they pace their entry into international investments in a manner which is acceptable to them.
Okay, so that is exactly our point. How do you gain that foothold in the international market? Siddharth, you've been, of course, at the forefront of ETFs. Is ETF the best way for an investor to get international exposure? I mean, the lowest cost and most beneficial?
Yeah, so again, just like in India, ETF provides a very low cost way to invest in global markets. The passive funds typically they track a benchmark and they provide a very transparent and known exposure to these developed markets. And again, these are very low cost in nature. And when we are thinking about investing in India, we think about ETFs and we think about how large cap funds are struggling to outperform the benchmark. People need to remember that this has already happened in developed markets, and that is why ETFs and passive products have grown so much especially in US, where active funds struggle to outperform the simple benchmark on a consistent basis. So considering the underperformance of active funds, considering the cost of active funds and the low cost of passive funds, ETFs per se seems to be a more logical choice if you want to start investing in global markets, and then eventually, depending on your investment objective, you can pick some other active funds. But as a starting point, ETF and passive funds makes much more sense when you want to start investing in global markets.
Okay, Vishal, what has been the acceptance in India, and which are the kind of these international ETFs which you're recommending or your clients are asking about?
We tend to believe that for most people to start off with anywhere between 10 to 25% is a good number for them to gradually build up to. And we need to obviously keep in mind that Indian markets make up only about 3% of global market cap. So they're very, very small in the context of what exists globally. Now, once they've got that decision done of how much they want to allocate to international markets, they then move to the next level where they start making selection choices of which are those markets that they want to participate in and what are the kind of ETFs available there. So you would find that the range of funds available, the actively managed funds investing internationally in India, are more than the number of ETFs currently available. I'm sure this will change over a period of time, but as of now, the numbers are much larger on the actively managed fund side. The ETF space is largely limited to something in the US, and there's a little bit of exposure that you can take into Hong Kong, for example. But otherwise, you need to go in and look at a combination of using actively managed funds and ETFs if you want to buy it in a simple form. If you want to go out and buy it using the liberalized remittance scheme, where you're allowed to transfer $250,000 overseas, then the range is much wider. You basically get access to every part of the world, depending on what you're excited about.
Okay, so this is a good point on which let me ask my next question to start is, what exactly is the opportunity that you're seeing globally as a fund manager? Vishal mentioned a lot of geographies, right?
US markets, especially in the last year, have done pretty well. There are a lot of themes which are not available in India. If you look at Indian markets, as Vishal mentioned, it only captures 3% in terms of the NCAP globally. And most of these, what we have in India are traditional sectors. We are talking about banks, we are talking about oil and gas, IT consultancy, etc. But if you want to participate in disruptive technologies, technologies which are creating new economies, which are disrupting the way we live in, like electric vehicles, e-commerce, social media, artificial intelligence, and robotics. If you want to get that exposure, I think that exposure is only as of now provided by companies which are listed in foreign markets, in US, in China, in Hong Kong. And that is one of the reasons why we get a lot of queries if we are coming up with a fund which will provide investor to that particular exposure, because people are aware that these technologies will provide a lot of growth opportunities to the companies which are present in that segment.
Vishal, what about the currency implications, right? For an investor, while you have the low cost benefit, etc., and I'm speaking specifically about ETFs, would the currency play take away a lot?
So actually, traditionally, the Indian currency has been a currency that has depreciated against the US dollar and most other developed market currencies. Having said that, I think it's important for investors to also keep in mind that a lot of global businesses tend to have revenues from many parts of the world. And therefore, there tends to be a fairly natural P&L and balance sheet hedge that exists for a lot of these businesses when you make those choices. So I would say that currency, while it's one parameter that should be considered.
Okay, so what about tax then?
Yeah, so tax is again something that over a period of time has become probably lesser important. What used to happen earlier was, when you had Indian equities getting taxed at zero long term, and you had foreign equities, getting taxed like a debt product where it was essentially 20% with indexation, the gap was very large. So a lot of people would kind of use tax as the reason why they would, go domestic. But since 2018, when long-term on equities also became 10% for domestic equities, and if you look at 20% long-term with indexation for international equities, effectively the gap is now very small. And therefore, our view is that it's smarter to just use your decision on how you want to diversify your portfolio across geographies rather than using tax as a reason. I think the only other thing that investors need to keep in mind around tax is the definition of long term. So in India, long term is equal to 1 year. When you're buying international equities, long term is equal to 3 years. And the way we look at it is that if you're buying equities, in any case, having an investment horizon of less than at least 3 to 5 years is probably not a good idea. So to that extent, I would tend to also get or give less importance to the tax differential, because I don't think it's that meaningful anymore.
Okay, fair enough. Siddharth, for investors who are considering, choosing, say, an ETF or even a fund of funds for that matter, for their international exposure, is there anything they need to keep in mind? I mean, as a fund manager, what would you tell your investor, 5 things or 3 things to look at before they choose an ETF?
Obviously, I think Vishal has already talked about it. The most important thing is obviously what the risk profile of the investor is. And typically, if you're investing in foreign markets, you should have ideally a horizon of 3 to 5 years. And that's the most important thing, right? You are thinking about diversification, but you should always keep in mind that when you're investing in global markets, it has its own set of risk factors which will affect the performance of the funds. That is one thing. Second thing which investors should also focus on is the cost. A lot of funds which are available in Indian markets, let's say a simple active funds which are investing directly in stocks, they have an expense ratio of almost 2.4%. The fund of fund have an expense ratio of 1.9%. Whereas if you look at ETFs which are present in the market right now, it has an expense ratio of around 50 basis point. So these expense also eats into your return. So that is one thing which you should obviously keep in mind when you are choosing the right fund. And lastly, the investment objective of the fund should align with your objective.
So then one more question. If say for example, I have chosen a US focused ETF, right, and that is one portion of my core portfolio. Now, like you said, there are risks, right, to every market. Now, winners keep changing, asset classes keep changing, no market performs consistently. What do I do with the one country focused fund when that country's market doesn't perform? So therefore, do I need a diversified basket of ETFs as well, and not just any one geography focus?
First of all, it's important. For domestic funds, we don't give it that much importance. But whenever you are investing in foreign funds, you should obviously look at the kind of exposure you are getting to respective geographies also. There may be a US based fund which is only 70-80% on US companies and 20% is coming from companies from outside US. So that is one thing which people should focus on. And I think as of now, people find US market more simpler to understand. People have that they can easily understand what is happening in US market comparatively. So people have a starting point of investing in US based funds only. But yeah, there have been some demands from the investor regarding emerging market funds or Europe-based funds.
So that one question out of curiosity, because we're talking about international exposures, we've seen a lot of stocks, they have Class A shares, Class B shares, and as an Indian investor, we just haven't understood entirely what this concept is. So can you, help us do that?
In most of the cases, if you have Class A and Class B shares, it typically depends on the kind of voting rights the holders of these categories of share will have. In a way, it's a poor comparison, but it will be what Tata Motors ordinary share and Tata Motors DVR are, which are listed in Indian equity market. So typically, when you have different classes of share, these shareholder rights in terms of voting, in terms of dividends, etc., differs. And typically, companies issue these shares so as to they don't want to maybe dilute their control over the company, but they want to raise capital, and that is why different classes of share may have different voting rights and different dividend rights. But mostly, in the end, apart from that factor, it again tracks the performance of the particular company in the long run.
Vishal, would it matter to an investor if they see a higher weightage for any one particular class of shares?
So I think for most investors who are individual, they don't participate so aggressively in in company resolutions, etc. So I think they find very limited value in a lot of this. In fact, the whole
Okay.
movement across countries has been for institutional investors to get more active and participate a lot more. I think retail individual investors tend to take very limited kind of exposure here. In fact, I think there's a much bigger question in here, which is effectively that for most individual investors starting off with their investments, we tend to find that they're better off starting off with either index funds internationally or index ETFs rather than trying to buy individual stocks, because there is this tendency to want to buy big brands when they're listed overseas, so that any particular sectoral underperformance or stock underperformance does not move you away from investing internationally. I think for a lot of Indian investors, they're going to start off with baby steps. And the worst thing that can happen is that their initial experience of buying internationally is poor. And then they go back 5 years or 10 years and say, I'm never going to do that again till they come back a decade later and restart this journey.
No, Vishal, I take your point entirely, and I would agree. But I was just reading, going through the fact sheet just this morning of, fund I mean, not an entirely international focused, ETF, but sorry, fund, but they have some exposure, right? Um, I noticed that the bets are not very aggressive. It's like 1% or a 2%. Now I understand that in an ETF you will have the index that you're tracking. But if somebody was to take a more concentrated bet, rather than go for the stock, should they also look at thematic international ETFs?
Yeah, I certainly think there is space in the portfolio for investors to do that as long as they are being intelligent in terms of the allocation that they're making. I think what we tend to find is very often the starting point is a thematic product, and that's where the risks tend to manifest itself. I think it's important that when they're starting off today with international investing, they start off with something more broad based and then they add in these for additional concentrated exposure that can be taken. So let's say if you're allocating 20% internationally and you want to take 5% of that and put it into a concentrated set of ideas around an ETF. I think that's certainly a good idea to do that. In fact, it's also a good idea to stagger in. There are ways to do that through SIPs, STPs, etc., especially through fund of fund structures. But I think pacing yourself right is going to be very important when you're taking concentrated bets.
Okay, so that's just one final question then to wrap it up. In an international ETF, how do you resolve issues like, say, tracking error because of the time difference?
Basically, the main issue when we are talking about international ETF is the time zone difference and the currency difference. So typically, in case whenever ETFs are being obviously there are two ways to invest in an ETF. One, you can come directly to the AMC, but you have to come in a larger basket size, or you can come to the exchange and buy and sell simply like a stock. On the exchange for investors, nothing changes apart from the fact that typically the prices of ETF on the exchange is driven by a futures, let's say a Nasdaq 100 futures, which is traded almost 24 hours, and depending on its movement, the ETF NAV moves on the, or the ETF price moves on the exchange, and investor can then buy and sell ETF on the exchange. That's the only differentiating factor compared to, let's say, a Nifty 50 ETF, where typically the prices of underlying securities are driving the prices of ETF on the exchange. But if someone wants to come to AMC and buy the entire basket of ETF in the larger size, then it is much more simpler in nature and for the AMC to simply go ahead and deploy the money when the concerned market, let's say US is opening during Indian evening time, to go ahead and deploy whenever the US market is opening and create the fresh units of the ETF for the concerned investor. The NAV which the investor will get will be based on the value at which these stocks, underlying stocks, have been purchased. Typically, apart from the pricing, apart from the time zone difference and the currency difference, most of the mechanism remains constant. In terms of tracking error, yes, the tracking error of foreign ETFs will be relatively higher than the Indian domestic ETFs, but it is not that high, which will create concerns among the investment community. And this tracking error is typically on the lower side, but yeah, more than what Indian domestic ETFs are.
All right, Siddharth, thanks very much for us in decoding the world of ETFs. So there you have it. International exposure via ETFs. Well, Vishal put it well when he said that, while India is a fast-growing economy, it is still only 3% of the global market cap and also just 3% of the global GDP. So clearly there is a lot of, potential that investors can explore overseas. Thanks very much, gentlemen, for joining in. And for viewers, thank you for watching. I hope you enjoyed and I hope you learned something from this. Thanks very much. Bye-bye.
Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.